Next, three broad approaches to pricing. Okay, we have to discuss about the broad approaches to pricing. One is that there is demand based approach. Okay. Second, there is a cost based approach, and then there is a marketing based approach. Demand based approach in the sense how much demand is there, how much supply is there, based on that. Okay, if you make a graph like this, demand curve will comes like this, supply curve comes like this. This is equilibrium quantity, this is equilibrium price. Okay, this is how demand and supply will decide what the price of a product is. And at the same time, there is cost based approach such as cost plus. Look boss, my cost was 15 rupees, I want profit of 5 rupees, which means I will sell it at 20 rupees. This is cost based approach. And then there is marketing based approach. Marketing based approach in the sense I will look at the market prices, I will put up a lot of money in marketing, build a demand, okay, and based on the response I will price it, okay, or based on the area that I'm getting into, okay, or based on the capacity of payment, okay, that there is in a particular country or particular region, I will price it, okay. Those kind of strategies are there. We will have a look at it. Okay. First, we have to look at the demand based approach. Okay. It is the economist viewpoint they were given. Okay. All this demand, supply, and all only economists will look at, nobody else. Okay. So if you ask any person, whoever is selling any kind of item or manufacturing and selling, he will not see a demand supply. He'll say how much my competitor is selling for. Okay. I will price it somewhere near there only. Okay. If I keep it like 2-3 rupees higher, I can argue that my quality is better. Okay. If you keep 10 rupees, 15 rupees higher, then you have to argue as well as prove that your product is better. Okay. If you price it lower, that will be your biggest strength. So those kind of things. Okay. Let us have a look at it. But this is a demand based approach, which means I will look at the demand only. Okay. Most firms recognize that there exists a relationship between the selling price of their product or service and the demand. By investigating and analyzing this relationship, it is possible in theory to establish an optimum price, that the price that will maximize the profits. The relationship can be often described as an inverse, okay, linear relationship. Okay. So what happens here is this curve you can see, okay, A is the price at which we sell nothing. Okay, which means if you price it here, let us say this is 100 rupees, and imagine this is a small eclairs chocolate. Okay, this is small eclairs chocolate, and for that you have kept 100 rupees. Will anybody buy?
No.
Nobody will ever buy this chocolate, okay, at 100 rupees. Yep. But if you reduce the price, okay, the quantity will be this much. If you reduce it further, quantity sold will be this much. If you reduce it further, it will be this much. If you reduce it further, it will be this much. Reduce it further, reduce further. So what do you see? As the price reduces, price see is reducing. Okay, this is P1, this is P2, this is P3, P4, P5, P6. Okay, so what is happening? As the price reduces, the demand increases. Q1, Q2, Q3, Q4, Q5, 6. Okay, so demand, okay, and price increases, demand decreases. Okay. Price decreases, demand increases. Okay. This type of relationship is called as what? Inverse relationship. Okay. Simple. No. A can also be viewed as a theoretical maximum possible price that could be charged before demand fell to zero. Okay, so P, this A, this point A, they are saying that it is theoretical maximum possible price. Okay. So if you keep it at that price, nobody will buy. Now, there are two methods of solution to problems investigating the relationship between price and demand: the algebraic approach and the tabular approach. Both we will look at it. First, we'll look at the algebraic approach. Okay, how do we do it? Economic theory states that the monopolist maximizes profit and marginal cost equals to marginal revenue. Now I will have to explain to you what marginal cost is, what is marginal revenue is. They have done a total mess out of it. I don't know, why these economic concepts are taught so wrongly. Okay, so I will take some time and I will explain to you how this entire thing works. So listen to me very carefully. Okay, so see, what happens is whenever you produce any item, let us say that, okay, there is a situation where I have an ice cream factory. Have an ice cream factory. Okay. And in the ice cream factory, okay, I have currently three processes. Let us say first one is accumulating the raw material, okay, mixing, and let us say uh, processing, packing, and delivery. Okay, three things. Okay. So I have two employees. I have two employees. Okay. If I have two employees, they are only doing all the accumulation of raw material. They are only doing all the mixing and processing. They are only doing the packing and the delivery. Okay. Now in this case, definitely the efficiency will be lesser. Okay. Because they are doing everything. Okay. So imagine that I introduce one more employee. Okay. I'm not going into the numbers at all. I just want this concept to sit in your head so that you will be able to answer any of the questions. Imagine that I put one more employee. Okay. The moment I put one more employee, what I can do is I can make sure that I will have one employee only for this process, right? One employee for this process. Okay. And this employee, whoever is there, I can put him in this process. Okay. So what happens here? Okay. As I increased the number of employee by one, now I increase the number of employee by one. What happens? My cost will definitely go up because the third employee also I will have to pay salary. Okay. At the same time, revenue also will go up. Okay. How much revenue will go up? Revenue will go up much more than the cost. Okay. Revenue will go up much more than the cost because right now this person is getting specialized over here. This person is getting specialized over here. This person is getting specialized over here. Okay. So no more problems, no more losses, no more people are busy, people are not there, losing demand, those kind of things will not happen. Okay. So revenue will go much more higher than the cost. This is understood. Now imagine I put up one more employee. So what happens when I put one more employee? Okay. Imagine that
Cost
one person is sick,
increases.
one person is busy, one person doing something. So this guy will go and add up to any of the places where it is required. Okay. Maybe these people have to write down certain things. Maybe these people have to repair some machinery. Maybe these people have to run errands, go give delivery, come back. Okay. Here there is more work for packing. Some extra demand has come. So this one person will help. But for this one person, again, my cost will go up, but revenue will go up much more further. Okay. Because efficiency has been added. Okay. Imagine I put one more person. Okay. Imagine I put one more person. Okay. What is going to happen is when I put six people, there will be two people in each process.
Yeah.
Okay. I can cater for much more need. Okay. But if at all you are an entrepreneur and you have put up this ice cream factory and you see that every time you hire one more fellow, your revenue is going up. Okay. So what are you going to do? You are going to keep hiring, isn't it? Okay. If I keep hiring, my revenue will keep going up. No. Okay. There is an optimum level of employees that can be worked in this factory. Okay. The moment that you appoint anybody more or appoint anyone, more than what is required, what is going to happen is this additional person who has come now, he will spoil everybody. He will go and talk. Okay, he'll go and chit chat because no work is there. Every work, too many people are already there to do all the work. Okay, so the work culture will get spoiled, and because of that, cost will go up because I hired one more person, but my revenue will start falling. Okay, so what is happening is every time that I hire one person, I will have additional cost, and that cost I will name it as marginal cost. Remember that every time I hire one extra person, see, marginal cost is that only, no cost of doing like one extra. Okay, so
Cost.
basically the cost of hiring one extra person is marginal cost.
Marginal cost. Yes, yes.
What
I
is
remember.
marginal revenue? The revenue increased because of that one person. Okay, so when only two were there and I introduced the third one, cost went up for the third one. At the same time, because of the third hiring, my revenue also went up. Okay, so what you have to do is in the initial phases when you start hiring, the revenue increase will be more than the cost increase. Revenue increase will always be more than the cost increase. So you have to keep hiring. Okay, you have to keep hiring until these two things are same. That is marginal revenue equals marginal cost. That is where your company is at optimum stage. The moment you go and hire more, then it will become opposite. Cost will become more, revenue will become less. That we don't want. Okay, so that is what the economists are willing to tell me over here. Okay, which these people have just told in one sentence, which for a person who doesn't know, like the concept and this thing behind it, will never understand it. Okay, so economic theory states that profit will be maximum when your marginal cost will be equals to marginal revenue. Okay, so that is where you have to do your production. Okay, now marginal revenue is the additional revenue from selling one extra unit. For example, what is marginal revenue? Imagine you sell one quantity, the price is 70, the revenue is 70, marginal revenue is 70. Marginal revenue means earlier you are selling zero quantity, now you sold one quantity. By selling one quantity, how much extra money you made from zero? From zero you came to 70, so that is marginal revenue. Okay, same way you sold two, price is 60. Okay, because when you're selling two items, you have to give discount. Nobody will buy from you just like that. Okay, if you say 1 kg tomato is 15 rupees, 2 kg 30 rupees, your mom will not buy in the market. You have seen it. When mom buys a 2 kg tomato, she say give me for 25. Okay, so here when you sell two, it is 60. Total revenue is 120, 60 into 2. Now earlier I had 70, now I have 120. How much marginal I have? 50. Okay, marginal is extra by selling one extra unit. Okay, then 3, you have to sell it for 50. Total is 150, is 30. 4, it's 40, 160, and extra is 10. 5, you have to sell it at 30. You get 150. Now negative. See, this is what happens. You can't just keep reducing the price. If you keep reducing the price, your marginal revenue will keep falling and it will go to negative. Okay, next. Marginal revenue is the additional revenue from selling one extra unit. For example, okay, you can see marginal revenue over here. They have shown marginal cost also. You see here they have shown marginal cost. This is the marginal cost. Okay, and they have shown marginal revenue. Marginal revenue kept falling only, because when you sell extra units, okay, per unit marginal cost will keep falling. Okay, so it went down, and wherever this marginal cost intersect marginal revenue, this is the optimum point. Okay, what they have told, this is where you have, this is your optimum level of quantity, this is what you have to sell, and this is the price at which you have to sell. Okay, now the optimum price is 50. At output less than q is equal to 3, an extra cost of making a unit is less than the extra revenue from selling it, so it's worth selling it. At output greater than 3, the extra cost of making a unit exceeds the revenue from selling it. Same thing what I told about the ice cream factory, they were told about this. Okay, you hire extra person or not, you have to see what is the cost of that person, what is the revenue that he brings. Okay, so optimum is 3.